first take. On expected lines, HDFC Bank is your top mover, up almost about 1% after a good set of numbers, and that's taking the market higher, 60 points higher now on the index.
For the markets, we're just up close to 20 points on the Nifty. The sensex has gained 150 points from the day's low. The Nifty banking index has recovered close to about 280-300 points.
It's more of the same in terms of what we saw all of last week, actually, the last, 6 or 7 trading sessions.
There goes the final tick, 17,891 on the Nifty, so just shy of 17,900, 65 points lower on the Nifty. The Sensex down 180 points. Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action. In 5 headlines, I am Prima Tendulkar and these are the headlines. Stock markets remain under pressure as the Sensex and Nifty fail to hold on to opening gains. Banks and metal stocks lead the decline. IT stocks and PSU banks rise as earnings flow in. Strong quarterly earnings drive Federal Bank higher. The lender reports a record net interest margin as numbers exceed street expectation. HDFC Bank is on the high growth path with a good pickup in income and higher margins despite deposit rates climbing higher. D-Mart owner Avenue Supermart closes 5% lower after it misses profitability estimates. Wipro's weak growth and muted guidance fails to live up to expectations. Just Dial jumps 10% on strong growth in revenues, profits, while record quarterly sales lift Sula Vineyards 14% higher. L&T Finance gains 3% post-earnings. Gold shines for the second straight day. Domestically hits fresh all-time highs. Expectation of a lower Fed rate hike amid softening U.S. inflation and a weakening dollar index supports the prices. And here's a lineup of what we have for you in store today. In Market Opinion, we've got Sanjeev Prasad of Kotak Institutional Equities and Corporate Voices. We have Srinivasan Vaidyanathan, CFO of HDFC Bank. Thierry Delaporte, CEO Wipro. Let's begin with the day's market action. Indian indices remained under pressure as benchmark indices failed to hold on to opening gains. The Nifty opened at levels of 18,050, but there was a slide through the course of the trading session. Both the indices slipped nearly 1% from the day's high. The mid-cap index under pressure too. IT stocks bucked the trend as major earnings flowed in. By the end of trade, the Nifty ends below 17,900, a cut of close to about 0.3%. Prashant Nair is here to wrap up the market action. Prashant?
It was a bit of a drift today, the market disappointing the bulls. There was a gap up, a meaningful one, which sold into and we never really recovered after that. No bounces, the Nifty ending 50-60 points lower. The Bank Nifty was down about 0.4% as well. Gainers coming through in PSU banks, which also came off the high but closed okay. IT and energy were the other two areas, and I'll come to IT stocks in a bit. Losses topped down in metals and autos, and there were particularly large losses in some pockets. As I said, the IT space and especially the large cap IT space stood out. Tech Mahindra up 3%, Infosys, HCL Tech and Wipro were some of the others which did well. Broader markets declines outnumbered advances. So D-Mart, JSPL, RVNL, PVR, there was a downgrade. Nykaa, Astral, Devyani. These are large liquid names and there's been some selling for the last few sessions which continued today as well. Gains were also there. Adani Green stood out. Sula, there was a business update. Markets liked it. Varun Beverages turned around after Friday selling. IOB, Union Bank, UCO Bank, PSU banks has been a theme which is trying to make a bit of a comeback. There is no US market session. Those markets are shut. So no global cues in that sense when we come back tomorrow morning. And it's also relatively a earnings light session Tuesday. That is tomorrow. A couple of insurance companies, that's about it. So we kind of pick up and carry off from where we left off today when we come back tomorrow. Back to you.
Thank you very much for that. In Market Opinion, Sanjeev Prasad of Kotak Institutional Equities expects a D-rating in many high-growth quality names, adds that the auto space will continue to see disruption as EVs scale up.
Starting to see a fair amount of disruption, which is coming across business models for companies which were once thought to be completely, with very, very solid modes, something which could never be breached. But of late, what we are seeing is many of the business models are starting to see some cracks. So over a period of time, you will see, de-rating in the multiples of many of these high growth / quality stocks. Automobile sector, really seeing a lot of disruption in terms of competition from electric vehicles, which will surely, but slowly but surely it will come in. If you look at Maruti's position, it's unfortunately become a fairly average player in the dominant segment now, which is the SUV segment. So on the one side, the hatchback segment has gone from 23% mix share in FY14 to something like 38% now, or in FY22. On the other hand, SUV segment has grown from 30% of total passenger vehicle sales to something like 40% in FY2022. So I don't know why the market still insists on giving such high multiples for a business model which is considerably weakened in the sense, it has a much lower market share in the dominant segment now.
Okay, let's get to the second headline now. Federal Bank gained 2% after a strong third quarter performance exceeding street expectations. They reported a record net interest margin, NIM, as well as a reduction in the cost to income ratio. Abhishek is here with the fine print. Abhishek?
Well, all the lenders have seen increase in their lending rates, and that is what is translating into strong NII growth and the net interest margin improvement that you are seeing across banks. So to begin with, Federal Bank, the all-time high net interest margin and the numbers have beaten our poll are the highlights of the result. The net interest margin has come in at 3.49%, which compares to 3.3% in the previous quarter. NII growth on a sequential basis is more than 11%, the best growth that you are seeing in 21 quarters. And YOY, the growth is more than 27%, which is one of the best that you are seeing in last 6 years. So a 5-quarter low in terms of cost to income ratio, which means that their operating efficiency has improved. Best return ratios that you are seeing in last 30 quarters or even more. ROA at 1.33% and ROE now touching close to 16% level. Asset quality, gross NPA ratio at 2.43% is the best in 21 quarters. Net NPA ratio, which has come in at 0.73%, is the best in last 30 quarters. The restructured book has also declined. It's now at 2.22%, perhaps the lowest that you are seeing in last 7 quarters. Volume wise or value wise, the restructured book has declined by 4% on a sequential basis. In terms of P&L, both the NII and PAT have beaten our poll.
Okay, Abhishek, thank you very much for that. HDFC Bank reported a strong set of Q3 numbers, with the bank posting its best ever return on assets. Speaking about the RBI nod for the HDFC twin merger, the bank's CFO Srinivasan Vaidyanathan said the expectation is to hear something next month.
Not heard yet, but we would expect it within the next month to. There's no particular time frame, right? This is not a particular schedule. For context, is that the merger process is progressing. The NCLT final hearing is on 27th January, right? And so thereupon, once it's adjudicated, then there are certain other processes, regulatory processes to go through. So we do have some time that this would take, and we are hoping that in the interim period there will be something.
That's about the financials and what we saw today. Let's get to the third headline then. D-Mart owner Avenue Supermart clocked losses of 5% today after both EBITDA and profit missed street expectations. The gross and the EBITDA margins have come in at a 7-quarter low, with the revenue per square feet still below pre-COVID levels. Banglam is here with more.
Well, it has been a weak quarter for them, no two ways about it. For D-Mart, the stock is lower primarily because, the EBITDA as well as the net profit was a sharp miss as against street expectations. The stock is at the low point of trade. The gross margins actually were at a 7-quarter low for the company. They've said that, the non-FMCG discretionary products for the company this time around, which are usually higher margins, haven't done well for them. And even if you look at the revenue per square feet, that metric hasn't come back to pre-COVID levels, even as all other matrices have come back to pre-COVID levels itself. So on the revenue front, the company met expectations, but those analyst expectations are also built around the company's third quarter update. The EBITDA and the net profit have been lower than street expectations, and as a result of which we've seen a slew of brokerage downgrades as well. Edelweiss, rather Nuvama, has actually said that they've cut their target multiple on the stock from 60 times to 55 times EV to EBITDA. We've seen a downgrade come by from Morgan Stanley as well, a downgrade to equal weight with the target price being cut. And UBS, who were always sellers in the stock, have also cut their target price further to around 3,500 odd rupees. The only thing to watch out for in D-Mart now is the fact that they've ramped up their e-commerce experience. Its operations have been expanded to 4 new cities. And they've also launched a new subsidiary to sell pharmacy products in store itself. So that could be another stream for augmenting revenues. But at 73, 74 times, it's always traded at a premium to the entire sector. And as a result of which, some of the halo is waning off.
Thank you very much for that. Now, all the four IT companies have come out with their numbers. The last one was Wipro, which reported its numbers on Friday post-market hours. So here we are here to tell you what the big takeaways, what the report card from the IT companies is. Well, the biggest takeaway is that things are steady. So despite the macro uncertainty, fear of higher furloughs, execution has been steady and the revenue growth has been satisfactory. In fact, 3 out of the 4 large IT companies, TCS, Infosys and HCL Tech, have reported a beat in revenues this quarter. Wipro was the only one which missed. Now, talking about Q3 numbers, if you look at the quarter-on-quarter constant currency revenue growth, it's HCL Tech which tops the chart with a 5% growth. And all the 4 IT companies have reported a double-digit year-on-year growth. Talking about margins, mixed bag. Infi TCS margins were lower than anticipated. They were hit by a return to normalcy costs like travel. But on the flip side, HCL Tech and Wipro reported a solid margin expansion and a solid margin base. The INR depreciation, coupled with the improvement in utilization aided by fresher hiring, boosted the margin performance. Now let's talk about the deal wins. Despite some slowdown in decision-making, deal wins have been largely steady. Not as bad as what the street feared. In fact, Infosys told us the large deal wins were at an 8-quarter high. TCS said their qualified pipeline was higher, and Wipro told us the overall deal wins in Q3 were at record levels. The companies also told us that their pipeline is very strong, though it's now more biased towards cost optimization deals, and Indian IT large caps are benefiting from vendor consolidation. All in all, FY23 is going to go down as a good year for the Indian IT companies. Infosys is likely to end the year with a 16 to 16.5% top-line growth, higher than what they had projected at the beginning of the year. Ditto for HCL Tech. TCS doesn't give you an annual guidance, but the street is anticipating a 13 to 14% kind of revenue growth for this year. That said, there is no visibility from any of the companies about what FY24 is going to look like. Tech budgets have not been finalized. The commentary seems to suggest Europe is a bit challenging. Decision-making is slow, but there is no deal cancellation. Wipro alluded to slower ramp-up in large deals, and there are furloughs seen in pockets like BFSI High-Tech. On the supply side, attrition is moderated sharply. There you have it, on a quarter-on-quarter basis, and hiring is muted. In fact, the headcount for TCS and Wipro has declined on a quarter-on-quarter basis. The company says it's because they they hired aggressively in the first 9 months. Attrition is on the decline, but the market fears that it could be the companies preparing for a slowdown. Whether or not that plays out, time will tell. For now, Q3 FY23 has been steady for the IT companies. In fact, let's hear out one of the big voices. Now, Thierry Delaporte, who's the CEO and MD of Wipro, we had a chat with him earlier. Listen in to what he had to say.
As we are looking into Q4, what do we have? We know there is a certain level of uncertainty in the economy. The macro environment is showing a certain level of volatility. In some industries, more than in some others, we know that, for example, a sector that has grown tremendously in the past, the tech sector, is more suffering at the moment, and that's a fact of life. It's a reality. But in this context, what's actually very visible for us is that we continue to win in the market. We continue to win deals.
Sticking with IT, and to take forward what we saw from the big boys is that IT hiring has been muted. Remember, both Wipro and TCS saw a net reduction in their headcount. So we had a chat with Pawan Goyal, the Chief Business Officer of InfoEdge, to get a sense of the hiring market. He said the non-IT hiring is robust, but the IT sector hiring is still facing some challenges. Listen in.
I think IT is where we see the challenge. Non-IT sectors continue to see a robust momentum. So now how will it play going into Q4? I don't have the crystal ball, but if I look at historically when things slow down in US, with some lag, IT usually picks up in India. But in the next quarters, we'll see that momentum picking up in IT as well.
Welcome back. You're still with us on Markets Today. Let's go over the rest of the headlines that we're tracking for you. The fourth headline for the day is L&T Finance was up more than 3% in trade today after disbursals for the third quarter rose 19% on a quarter-on-quarter basis. Abhishek is here with the details. Abhishek?
Well, the disbursals continue to remain strong, up about 32.8% YOY and about 19.1% sequentially. However, this is not translating into meaningful AUM growth, because in the last 8 quarters, if you see, the disbursals have been close to 79,800 crore, while the AUM has declined by 11,670 crores. So AUM growth continued to remain weak, up just 3.4% YOY, while it has declined by 1.85% sequentially. Even the focused AUM has declined by 1.8% quarter-on-quarter. ROE continues to remain weak at about 8.4% when compared to 8% in the previous quarter. However, the PNL has been strong given the fact that the net interest margin is at all-time high of 7.4%, and X of exceptional one-off items that you have, the PAT has grown by 39.3% YOY and about 11.8% sequentially. The asset quality largely stable, but slight hiccup given the fact that gross NPA ratio is at 4.21% when compared to 4.02% in the previous quarter. Back to you.
Thank you very much for that. Let's talk about Just Dial. The stock was locked in an upper circuit of 10% after a strong showing in Q3. Revenues have come in at 8% on a quarter-on-quarter basis, up nearly 40% on a year-on-year basis. Look at the revenue trajectory. Revenues have been pretty steady over the last 3 quarters, and on a year-on-year basis, the growth rates have only been improving, and this quarter it hit nearly 40%. Margins expanding for the third consecutive quarter. It's come in at a 7-quarter high at 12.2%. Profits up 44%. Paid campaigns, that's up nearly 19% on a quarter-on-quarter basis. Citi says Q3 numbers, the top line was in line, margins were a beat, but valuations are inexpensive, because remember, out of the market capitalization of 5,500 crores, nearly 4,000 crores is the cash on the books. So if you look at the valuation X of the cash, according to Citi, it's pretty inexpensive, which is why they have a buy rating with a target price of 735. Just Dial, the stock was very excited in trade. Another one, Sula Vineyards, was also higher in trade. The winery gained 15% after reporting its highest ever quarterly sales. Mangalam is here with more details.
Well, I may not be drinking, but I definitely could have been visiting one of those parks, etc., right? But, Sula Vineyards reported a strong third quarter update. So 13% jump in their overall revenues year on year. And it's the highest that the company has reported on a quarterly basis. It's also the first time they've reported numbers ever since they've listed. So a 13% jump in their own brand consumption, which is the mainstay of the company. The other part of the business, which is also tourism, wine tourism, has seen a 13% growth. From the start of this year to now, there's been a 28% jump in their own brands revenue and 48% jump in wine tourism as well. And that, of course, comes on a low base. Going forward, wine tourism business doing well could be a bigger trigger for them, because this is a high margin product. And another important trigger for them is their new capacity coming on stream, 2.5 million litre cellar, which has come on stream right in time for the 2023 grape harvest season, which the company's release suggests that is likely to be strong. So, if the harvest season is good, with them having increased capacity, could do well for them, and that would mean that there could be further support for volumes going ahead as well. So good update, good outlook, and the stock up 11%.
Sula, that's the category creator in this segment. Let's get to the fifth headline then. Gold shines for the second straight day. Domestically, it's hit a fresh all-time high. Expectations of a lower Fed rate hike on the 1st of February amid softening US inflation and a weakening in the dollar index. Remember, the dollar index has fallen to levels of 102, and both these factors are supporting gold prices. Manisha is here with more details.
It's the second straight session of all-time highs for the gold prices in the Indian markets, and with this we've reached above 56,500 rupees per 10 grams. When you look at the gold price trajectory, we've gained 5% from the month of January. It was nearly 4% up for December and 7% up in the month of November as well. In the international markets, the gold prices have gained up by $300 per ounce in the last 3 months as well. Some people are calling it overbought, but until the time the gold prices on chart hold at $1,880 per ounce on the lower side, markets do believe that this rally could perhaps consolidate, even continue on the higher side. 25 basis point of a rate hike in the first week of Feb from US Fed has been baked into the prices now. Any surprises there is what would give you a knee-jerk reaction coming in. The US dollar index trading at a 7-month lows, the treasury yields on the lower side, slowdown concerns are some of the factors which have led to buying in gold. Add to that the Indian wedding season which has kick-started, and remember 50% of jewelry that's bought in India happens during the wedding season, so that is where further support comes in from as well. And then you have the banks and brokerages also expecting that in the international markets as well, you could be looking at gold making all-time highs yet again. Most of the banks and brokerages do believe that $2,000 per ounce, once that is seen or reached on the higher side, we are headed towards 2100, 2200 are the kind of levels that banks like Saxo Bank, Citi, Bank of America, Goldman Sachs seem to be talking about.
All that glitters is expensive. Manisha, thank you very much for that. With that, it's a wrap on this edition of Markets Today. Continue watching CNBC TV 18 for more business updates.